Welcome back to Accounting Matters. I'm Nicole Harger, Senior Managing Director here at Embark, and I'm joined, as always, with Adam Olsen, our Head of Practices. Adam, good to be back.
Yeah, great to be back. It's been a minute, but I think we've got a great topic today that I think is going to feel genuinely timely for a lot of listeners. I know we've had a lot of clients speaking about what we're going to hit on today. And I think that's really because the market is telling us something that's worth paying attention to.
It really is. So for those tuning in for the first time, Accounting Matters is a podcast focused on the accounting, financial reporting, and broader finance topics that matter most to CFOs, controllers, and finance leaders. And today we're kicking off a two-part series on SPACs. Adam, before we dive in, can you set the stage a little bit, starting off with why are we talking about this right now?
I know I think we did a podcast on SPACs years ago, but times have changed a bit. And I think the numbers are pretty hard to ignore on that note. So SPACs alone accounted for 40% of the US IPO deal count in 2025. And that was up 27% from the year before. And if we fast forward and kind of look at just what's happened so far in 2026, so just looking at the first 2 months, for example, 50 SPACs raised nearly $10 billion compared to the 24 traditional IPOs that occurred during that same period that raised only $7 billion. So whatever you thought you knew about SPACs being a 2020, 2021 phenomenon, and then kind of the fall down of that, that story has changed again, and it's changed pretty significantly.
Yeah, and look, SPACs carry some baggage, right? The 2020, 2021 boom that you talked about did not end particularly well for a lot of participants. And that's actually exactly why we thought this deserved a full series, because there is a lot of noise in the market right now, and we want to give CFOs and controllers and finance leaders something that's actually useful. And so whether you're actively evaluating this path or just want to understand the landscape, we're going to try to give you a grounded view of what's actually happening.
Yeah, that's the goal at least, right? So let's kind of break down how we're going to structure this series. So episode 1 that we're doing today is going to be more about the what and the why. We're going to talk through how SPACs work, the equity instruments involved, and a typical structure. We'll talk a little bit too about kind of why they fell apart after 2021, and then what's really driving that current resurgence that we're seeing. And also how to think about, maybe the SPAC kind of exit path versus the traditional IPO decision that I know a lot of companies kind of have to navigate and think through. And then in episode 2, we're going to go deeper more on the accounting and reporting side like we do here often. So we'll talk about the de-SPAC process itself, the accounting consequences for financial statements, those key kind of technical accounting issues that finance teams need to understand, going into those transactions. So whether you want to stay for both or focus on one that's most relevant to where you are, we've got a lot to cover.
All right, let's dive in. Starting with kind of the foundation. For someone who's heard the term SPAC but hasn't been through one, Adam, will you walk us through what this structure actually is and how it works?
Yeah, so a SPAC, which is a special purpose acquisition company, it's essentially a shell company, right? It has no operations, it has no revenues, it has no products. It's really formed for one specific purpose. And that's to raise capital through an IPO and then use that capital that they raised to go then and acquire a private operating company. You'll often hear people kind of refer to SPACs as those blank check type companies, which actually does capture the concept pretty well, right? You've got investors that are essentially writing a check to a sponsor team and trusting that team to go find a good target for them. A SPAC lifecycle has really kind of 3 distinct phases that it typically goes through. And so I think it's worth walking through each one because there are different parties involved in different phases and different incentives that kind of align with those phases as well. So starting with the first phase, which is just really the SPAC formation itself and the IPO of that SPAC. So a sponsor, typically in this type of structure, which is a private equity firm or a group of experienced executives or maybe some type of investment professional or hedge fund or investment bank, whoever, forms the SPAC, and they take that SPAC public. At the IPO, shares are typically sold at $10 per unit. And the word unit is actually an important distinction here because each unit includes kind of two equity instruments. So it includes both a Class A share as well as a warrant. And I know we'll come back and talk a bit about the instruments in a few minutes here. But the cash that's raised from that IPO then goes into a trust account. And that's where it's held, and it continues to earn interest. And it stays there basically until that SPAC, which is then going to go search for a target, identifies that target. And then another party in the kind of formation phase of the SPAC is the sponsor itself, right? And they receive a portion of equity too, in what is typically classified as a Class B share or founder shares. And those shares typically make up 20% of the post-IPO equity, which is, a large number for a very small upfront investment. And that really kind of serves as the promote structure. And that was really, I would say, one of the most contested aspects of kind of the whole model. And I know we'll get into that a bit more here.
Yep. So right from the start, the sponsor does have an economic interest that's tied to closing a deal. So not necessarily how the deal performs afterward. And I think that's actually one of the things that makes the current moment feel different. Institutional investors have gotten a lot more sophisticated about spotting that misalignment in pricing into their willingness to participate. The promo is still there, but it's being scrutinized in a way that simply wasn't back in 2021.
Yeah, that's exactly right. And the scrutiny is partly regulatory, which we'll touch on, but it was also partly just market driven. So we'll get into that regulatory piece. So the SEC in 2024, they issued a bunch of rules that actually changed some of this. But let me go ahead and just kind of wrap up the other two phases of the SPAC life cycle. So after that IPO we talked about, the SPAC then enters kind of phase two, which is the search phase. So the governing documents of most SPACs give them anywhere from 18 to 24 months typically to identify and announce an acquisition target. So during this period, keep in mind the SPAC that was formed is an SEC registrant. That SPAC still has to file 10Ks and 10Qs during that period. It has public shareholders, ongoing disclosure obligations, no different than any other public company. But it's not really doing anything operationally, right? We talked about instead what the SPAC is doing and kind of the members of the SPAC. They're conducting diligence on potential targets. They're evaluating those targets, negotiating terms, again, trying to find that right fit for that private operating company to acquire. But keep in mind, if they can't close a deal within kind of that defined 18 to 24 months typical range, the SPAC generally will dissolve, and all that capital that was in that trust account will go back to the investors. So if you think about it, there is a clock that is essentially running the entire time, which creates its own kind of pressure. And then to wrap up kind of the life cycle review here, so the third phase is actually that business combination itself. If a viable target is found, and this is often what is referred to as the de-SPAC transaction. And so this is where that SPAC merges with or acquires that private operating company. The deal requires shareholder approval. So the SPAC will file a merger proxy with the SEC. And here's actually where one of the most consequential mechanics in the structure does come into play. So those SPAC shareholders that put their investment into that trust account, when that target's identified and it kind of goes up for vote and all that, those shareholders do have the right to still redeem their shares, meaning that they can take their approximately $10 per share investment back from the trust account rather than trying to continue on as a shareholder of that new combined entity. And in fact, they can even vote in favor of the deal and say, yeah, we think this is a good target, and still decide to walk away with their money if they don't want to stay invested in what's coming. So that optionality is quite unusual compared to what you would see, like obviously in a traditional IPO.
Yep. And that redemption feature is really what makes the SPAC structure fundamentally different from a traditional IPO. In a traditional offering, once that capital is raised, it's committed. Investors don't get to kind of change their minds at the finish line. But with a SPAC, that optionality exists all the way through the shareholder vote, which means from the target company's perspective, you don't actually know how much capital you're going to receive until very close to closing. And that's a meaningful planning challenge for any CFO trying to size the post-combination business.
No, you're exactly right. And the implications go beyond just planning. They actually affect the deal structure, how much you rely on PIPE financing as a backstop, and the accounting, and in fact, which I know we'll talk a bit about more on in episode 2. But if we look back to 2021 and 2022, we saw redemption rates that were genuinely remarkable in the wrong direction. In some cases, exceeding 90% of the trust capital walking out the door before closing, which you can imagine is problematic. And so what that did is it effectively left those combined entities with a fraction of the capital they were expecting. And that's a significant part of what broke so many of these transactions, a few years back.
So what's the mechanism that addresses that risk? Is that where PIPE financing comes in?
Yeah, that's exactly where PIPE financing comes in. And I think that's a great transition because the equity instrument landscape in a SPAC transaction, I think, is worth spending some real time on. So maybe we head there next.
Let's do it.
All right. So one of the first things a CFO at a target company needs to understand when evaluating a SPAC is that you're not just agreeing to a valuation. You're agreeing, frankly, to an entire capital structure that often has multiple layers of equity instruments carrying, their own economics for each. It has its own dilution profile. And then if you think about it, it's going to have its own accounting complexity, which I know we help companies navigate a lot. So the headline deal value is never really the complete picture is what I'm trying to say here. So let me walk through some of the main instruments that you'll typically see. So we've already talked about those founder shares. So the Class B shares are issued to the sponsor at formation for what's typically a nominal investment. Like I said, oftentimes it's just a few $1,000s, but they still represent, like I said earlier, roughly 20% of the post-IPO equity. At the closing of the business combination, those shares often convert into Class A shares. So from the moment the SPAC is formed, approximately 20% of the combined entity is going to the sponsor for an investment that's effectively a rounding error, if you will, relative to the capital the deal will raise. So that's the promote that they earn. In 2021, when deals were closing regardless of quality, because sponsor economics were pushing everyone towards just doing a de-SPAC, whether the de-SPAC was a good de-SPAC or not, it didn't really matter. And so this structure did attract a lot of criticism. Fast forward to today, like in the current market, sponsors under genuine reputational and investor pressure are starting to negotiate modified promote structures. So they're forfeiting portions of their founders' shares, or they're structuring vesting around post-combination share price targets, because institutional investors are insisting on better alignment. And I think that's a meaningful market evolution that we see today versus what SPACs were doing a few years back.
Yeah, and the SEC's 2024 rules require a lot more transparent disclosure around that promote structure now, right?
They do. So sponsors have to disclose the economics much more clearly, how much they invested, what their effective cost basis is on the founder shares relative to what public investors paid, the conflict of interest inherent in the structure. So that transparency does matter because investors can now see more clearly the economics don't align. So let me talk next about the warrants. So at the IPO, each Class A unit, as you'll remember, included kind of two pieces, both the Class A share plus a warrant. And that warrant typically will have an exercise price of $11.50. And that gives the holder the right to purchase one more Class A share at that price. Oftentimes, too, the sponsor also purchases additional warrants separately in a private placement vehicle. Those sponsor warrants often have slightly different terms than the public warrants, particularly around like early redemption features and settlement provisions, et cetera. And those differences carry accounting consequences. And in fact, the SEC back in 2021 issued a staff statement that effectively required a large number of SPACs to reclassify their warrants from equity to liabilities. And that offset a whole wave of restatements across the market as a result of that accounting change. And I know we'll go more into this in episode 2, so I won't belabor it too much here. But the thing to understand at this stage is that the warrants don't disappear at closing. They typically remain outstanding for periods up to maybe 5 years after the business combination. And so that continues to create ongoing dilution potential and ongoing accounting complexity for the combined entity.
Yeah, and I think that's something that catches a lot of companies off guard. You know, the idea that you close the deal, you ring the opening bell, you're a public company, and then all of a sudden you realize you're managing this 5-year overhang of instruments that require technical accounting attention every single quarter.
Yeah, it really does. And the P&L impact of liability classified warrants, as you know, is something finance teams need to understand as well before they're in the middle of it. So, right, if warrants are classified as liabilities, they're marked to market each reporting period. Changes in that fair value, they run through the income statement, can create a lot of volatility, and it has nothing necessarily to do with the operating performance, and it can be confusing, frankly, for a lot of investors who aren't used to seeing it. So let's move on to like the last, and we mentioned this one a few times here, but PIPE financing. And so PIPE stands for private investment in public equity, and understanding the PIPE is essential really to understanding how the current SPAC market actually functions. So PIPE investors, which are typically institutional pension funds, hedge funds, maybe some family offices, they commit to purchasing shares in the combined entity at a negotiated price. That commitment is funded at closing, usually simultaneously with the business combination, and is not subject to redemption. So where public shareholder redemptions can drain that trust account, how we talked about what's happening, the PIPE commitments are locked, and they help provide the floor of committed capital that the deal actually needs to function. In 2021 period, however, PIPE terms were structured with meaningful discounts and additional warrants attached, which created their own dilution challenges. So some PIPE investors in that era were momentum driven rather than fundamentals driven, and they weren't doing the kind of diligence that we would see today. That would have probably slowed down the deals back then as well. But like I said, today's PIPE market looks materially different, right? And institutional investors are doing rigorous work around understanding the deal economics before committing capital. Deal terms are more standardized as well. And frankly, the quality and identity of a transaction's PIPE investors has really become a market signal, right? You've got sophisticated institutional PIPE participation is read as a vote of confidence in the target.
And so from a CFO's perspective, is the PIPE essentially the backstop that makes the deal work, even if public shareholders redeem heavily and walk away?
Yeah, that's exactly how you can think about like the purpose of PIPE financing, right? It allows the deal to close with a reasonable capital base, even when redemptions could be high. And the PIPE market itself has changed significantly since 2021.
It really has. So in the 2021 period, PIPE terms were sometimes structured with meaningful discounts and additional warrants attached, which created their own dilution challenges. And frankly, a lot of PIPE investors in that era were momentum driven. They were betting on the broader SPAC wave rather than doing rigorous diligence on individual targets. And what we're seeing now is quite different. Institutional PIPE investors are doing serious work before committing. Deal terms are more standardized, and the identity of PIPE investors has become a genuine market signal. As you mentioned, sophisticated institutional participation in the PIPE is read as a vote of confidence in the target. And so if you can't get quality PIPE investors to commit, that tells you something about how the broader institutional market views your equity story.
Yeah, and I think there's also an accounting dimension to the PIPE worth flagging here that I know we'll talk about in the next episode. But if PIPE subscribers happen to be existing shareholders of the target company, their voting interest in the combined entity may be attributed back to that target's pre-combination shareholder group for purposes of determining which entity is the accounting acquirer, and that can affect the whole accounting model, right, if you think about it. So it's just an example of how instrument decisions and accounting consequences are connected in ways that aren't always immediately obvious at the negotiating table. So I think it's important to have the right parties involved and familiar with what's going on. Lastly, here is just one other kind of equity component that you might typically see in a SPAC transaction, which is around earnout arrangements. These are extremely common in the current SPAC deals we're seeing. And earnouts really, right, if you think about it, are just a mechanism to bridge valuation gaps in negotiation. The target selling shareholders will receive additional shares typically in the combined entity if the stock hits specified price thresholds within a defined period after closing. That's an example of how it might be structured. So you might see it where 2 million additional shares are issued if the 40-day volume weighted average price reaches a certain threshold. It really helps ensure that SPAC investors don't overpay upfront, and instead the target selling shareholders get upside if the equity story actually does play out.
And then the flip side to that, the earn back arrangement is worth understanding too, because it's become more common as institutional investors push back on sponsor economics. So in an earn back, the SPAC sponsors' shares are subject to forfeiture if specified price targets aren't met within a defined window post-closing. So rather than the sponsor automatically keeping their 20% promote regardless of performance, a portion of those shares has to be earned by the combined entity actually delivering for shareholders. So from an alignment standpoint, that's a meaningful structural improvement over what we saw in 2021.
Yeah, exactly. And the accounting for earnouts cuts in both directions, right? Whether it's structured as contingent consideration or compensation, equity or liability classification, those are real questions that have financial statement consequences. And I know we'll talk through more of that framework in the next episode.
So let's move on and talk about the history here, because I think understanding what went wrong in 2021 actually makes the current resurgence more legible and helps you understand which risks have genuinely been addressed and maybe which ones haven't.
I guess history books on SPACs. So SPACs have actually been around, late 80s, early 90s, though most people don't realize that. I think they've been in existence for that long. And they've existed in various forms over the decades, but they were largely at the margins of capital markets before 2020. What changed was a very specific confluence of conditions, right? If you think about the 2020 era, there were near zero interest rates, enormous amounts of capital that was looking for returns. You had pandemic era liquidity that was flooding the system and a risk appetite that was genuinely extraordinary for the times. And in 2021, SPACs raised $144.5 billion. And that number I think is really hard to process in retrospect. And a significant portion of what that capital went into was also problematic. So many of the targets entering SPAC transactions in that period were pre-revenue companies with ambitious 5-year projections and very limited operating history. The liability safe harbor that existed at the time for forward-looking statements made it possible to put aspirational financial models in deal documents without any meaningful legal consequences. And sponsors also had powerful economic incentives to close deals regardless of the target quality, because their economics were tied to closing, really, and not so much the post-closing performance. PIPE investors, as we kind of talked about, in some cases were essentially momentum driven, and the public shareholders who had that redemption option, I mean, candidly, right, as we mentioned earlier, they used it in numbers that nobody really anticipated.
Yeah, the redemption wave that followed was really something the market hadn't fully stress test. And when you have 90% of your trust capital walking out the door, the combined entity you envisioned when you structured the deal is almost unrecognizable from what actually closes. And we saw situations where companies had built their entire post-combination operating plan around a certain capital base. And then by the time the deal closed, there was barely enough cash to fund short-term operations, let alone kind of the growth strategy that everybody was projecting. And so this kind of mismatch between deal expectations and economic reality became very visible very fast.
Yeah, and it also exposed the fundamental misalignment at the core of the structure as it was being used at the time. So the misalignment between sponsor economics, incentivized to just close, right, and shareholder economics, which needed to actually, for the deal to actually perform. And that became highly visible to everyone. So by late 2022, the average de-SPAC transaction was down, almost 40%. And in some more notable cases, the losses were even more severe. And so this is when I think the SEC started paying more attention to kind of what was happening here. And the regulatory response that culminated in some rules that were effective back in July of 2024. So the most consequential change looking at those rules was eliminating that safe harbor for forward-looking SPAC projections. So without it, aspirational 5-year models carry, frankly, real legal exposure and require substantiation that the 2021 era deal documents simply never had. The rules also required much more transparent disclosure around sponsor compensation, conflicts of interest, like we talked about, and just transaction fairness, just so investors kind of know what they're getting into. And the banks underwriting the de-SPAC transactions also now face an independent fairness determination requirement that didn't exist before. And so the effect has been that a market that's maybe smaller, but more disciplined, and where we had weaker sponsors before and lower quality targets, those have mostly gone to the wayside, which is good.
Yeah. So now in 2025 and into 2026, who's actually driving this resurgence? Because you mentioned the PE angle earlier, and I think that's central to this story.
Yeah, it's the structural driver, at least from my perspective. So PE portfolios are carrying a significant inventory of mature assets well past their typical exit windows, right? And so the fundraising vintages from roughly 2015 through 2019 created an enormous backlog of companies that need exits. And PE sponsors are under essentially LP pressure to return capital at some point. So when you have a fund lifecycle running long and a portfolio company that's generating real EBITDA by now and cash flow, you need an exit path that offers both speed but also valuation certainty. And that's exactly what a well-structured SPAC merger can provide. And that's, like I said, very different than what we had in 2021. The PE-backed companies entering SPAC transactions today, like I said, they've got demonstrated operating histories, seasoned management teams, more mature finance functions, frankly, and they're not just projection-driven like promises and stories that everyone's trying to tell. They're businesses that have solid financial records and operating infrastructure that does support public company obligations, at least in theory, right? And I think this also just kind of emphasizes why the readiness conversation, and we'll get into that more, I know, in the next episode, is even more important for companies to establish those strong fundamentals.
So it sounds like the story of why SPACs failed in 2021 is actually the same story of why the structure can work now. Is that kind of a fair statement?
Yeah, I think that's a fair read. The structure itself, I don't think was ever inherently broken. The SPAC economics, if you think about it, the trust account, the redemption option, the PIPE financing, the earnout structure, they all have their specific economic purpose. What broke, I think, in 2021 was the discipline about what went into the structure and the alignment between sponsor incentives and then the shareholder outcomes that we've hit on. So both of those things, I think, have improved, right, meaningfully, driven by like that regulatory pressure, the reputational consequences, I think, of having failed SPACs in the past. And then again, a PIPE market that I think is a lot more selective today than it was in the past as well. And so I think the numbers actually reflect that. So if you look at some of the data in 2025, 138 SPACs raised almost $26 billion, which was roughly 3 times what it had raised in 2024. And, SPACs were representing almost 40% of the U.S. IPO deal count, as we talked about at the top of this episode. And so the market, I think, has come back, but the terms are materially different.
And I think for our listeners who are finance leaders at PE-backed companies, that different terms piece is actually the most relevant takeaway from the history. The bar for what makes a credible SPAC target today is legitimately higher in terms of financial track record, finance function maturity, and operational readiness, which is both, a higher hurdle, and if you clear it, a much more credible path than 2021 ever was.
Yeah.
Maybe now let's spend some time on the comparison that I think a lot of CFOs and their boards might actually be working through, which is if we're considering a path to the public markets, how do we think about SPAC versus traditional IPO, and what are the real trade-offs?
Yeah, and right, and that's the right question that those CFOs should be asking. And I think it's fair to say that there isn't a universal answer to that question always, right? It does generally depend on the specific situation, but I think what might be helpful is talking through some of the factors that typically matter the most when you're asking that question. So the most meaningful and durable advantage of the SPAC structure usually comes down to two things. It's the speed of the transaction and then the valuation certainty. In a traditional IPO, you go through a book building process where the ultimate offering price isn't determined until you're essentially at the finish line, if you will. And so market conditions can shift during that time. The valuation you expected 6 months into the process may not be the one you get at pricing. However, in a SPAC, you negotiate the valuation with the sponsor and agree on it at signing before the proxy merger is filed, and before the shareholder vote, before market conditions have had a chance to move against you. And so for a PE-backed company where the sponsor has specific fund life cycle commitments to their LPs with real timelines, I think that certainty has genuine economic value that can outweigh some of the other considerations.
Yeah, and speed matters in the context beyond just the timeline, right? It's about when capital actually gets returned to LP investors and whether the fund can raise its next vehicle.
Exactly. And so a traditional IPO too, right, it typically runs, I think in a well-structured one, at least 12 to 18 months from decision to execution. But a de-SPAC moves much faster, though I guess I should be very direct about this. The readiness requirements are just as demanding as the traditional IPO.
Right.
So the SEC expects the target company's financial disclosures and the merger proxy to essentially be equivalent to what you would see in an IPO registration statement. You've got the PCAOB audited financials, the full Reg SX compliance, MD&A risk factors, you name it, all of that is still required. And so the timeline advantage is real, but I don't think it necessarily means you can shortcut all the preparation. And so I think that's a critical distinction also just to highlight here.
And so what about the projections question? That used to be one of the big SPAC selling points.
Yeah, it was. And if you just circling back to the 2024 rules that we hit on, right, that changed that significantly. So pre-2024, I think one of the most frequently cited advantages of the SPAC structure was the ability to include that forward-looking financial projection in deal documents. That's something obviously traditional IPO registration statements do not permit. So for growth stage companies where the future story was more compelling than their historical record, that was a real differentiator back then. So with that safe harbor gone now, projections are still possible technically, but they do carry more legal exposure and require strong defensible substantiation, if you will. And so for a PE-backed company with a solid 5 to 7 year operating history, maybe this matters less because you're actually selling the demonstrated financial track record of that business, which is more credible anyways, and doesn't require the same projection crunch. So the narrowing of this advantage has actually disproportionately affected the kind of targets that probably shouldn't have been doing SPACs in the first place to begin with.
And what about cost structure? I think there's a perception that SPACs maybe are cheaper than traditional IPOs, and it's a perception I'd push back on pretty directly. When you actually model everything out, the promote, the warrant dilution, pipe terms, transaction costs, the total dilution picture looks quite different from the headline valuation number. And so neither structure is inherently cheaper, but the SPAC's cost components are more dispersed and much easier to underestimate.
Yeah, and I think that's exactly right. And it's one of the areas I think where CFOs maybe get caught off guard. So a traditional IPO has the underwriter fees that, run maybe anywhere from 5 to 7% of the total proceeds. That's visible and relatively straightforward to the model. In a SPAC, you got the 20% sponsor promote is the most visible piece, but your warrant dilution compounds on top of that, and warrants tend to get exercised when the stock is performing, which means real dilution at a moment that matters, if you will. And pipe terms may carry their own discounts as well. So transaction costs and advisory fees add further to that. So when you aggregate all of that across multiple redemption scenarios, I think the picture at the end of the day can be quite material relative to what a clean IPO would have cost anyways. So the analysis needs to happen, I think, right before the letter of intent is signed, just to understand that.
So if a company is working through this decision, when does the SPAC path actually make more strategic sense?
So, my opinion, I think a few conditions make it genuinely compelling. So first, you're PE backed with real exit timing constraints, and you value valuation certainty over the potential upside of a hot IPO market. I think second could be your historical financials are strong and can withstand institutional scrutiny. You don't need to have those forward-looking projections to tell your story. Third, your sector has public market comps that support a negotiated valuation rather than requiring you to maybe argue for a premium. Fourth, and I don't think I can emphasize this one enough, you actually have done the work to be public company ready before you sit down with a SPAC sponsor, not planning to, not expecting the process to create the time to do it, actually completed what that preparation needs to be. And then, like I said, we keep saying it, we'll get more into that in episode 2, but it is the single most consequential variable in whether a de-SPAC transaction actually succeeds, I think, on the other side of closing.
Yeah, I couldn't agree more. But before we close out episode 1, let's spend a few minutes kind of on the practical side. So maybe the mistakes companies make going into this process and how CFOs can really best position themselves to avoid them. What are we seeing most consistently?
So I think the most pervasive mistake by a wide margin is treating public company infrastructure as a post-closing project.
Yeah.
So companies, they arrive at that de-SPAC process and they don't have the mature finance functions. They don't have that kind of PCOB level audit readiness. They're without documented and tested internal controls. They don't have the capacity to actually close the books on the compressed timeline that's needed, especially if you think about quarterly reporting, right? And they discover, for example, the 4 business day clock for the Super 8K, the 40 to 45 day 10Q deadline, the SOX compliance obligations. None of that really waits for you. You have to be ready. I think the companies that navigate this well started that preparation probably a year, maybe longer before that. They ever had really like a serious conversation with a SPAC sponsor, and that may seem extreme, but that's what usually results in the best outcomes.
Yep. And then there's a specific disclosure consequence to that readiness gap, right? Because material weaknesses and internal controls obviously don't stay private.
Yeah, they don't. Right, material weaknesses and internal controls have to be disclosed in the merger proxy. It's not discretionary. For private companies that have never had to think about SOX compliance, discovering a material weakness mid-process, as you can imagine, is going to be extremely disruptive to the timeline, maybe to the narrative that you're trying to build with your investors, and sometimes to the deal itself, depending on how severe. I think the time to identify and remediate those issues is before the process begins, and not obviously during it, if you can. I know not everything's avoidable. I think the second pitfall is also not fully modeling the dilution before signing. So I think we flagged this earlier in the kind of financial instrument, equity instrument discussion, but it deserves, I think, another mention here. So again, the headline valuation is not the economic deal. You need the fully diluted cap table at closing modeled across a realistic range of redemption scenarios. So you also need to think about what is the maximum redemption scenario, or frankly, the worst case scenario, and what does that look like? And does it provide enough capital for the transaction structure to survive? Sponsors, I think, will put their best foot forward in the materials they share at the letter of intent stage. I think it's CFO's job is to really pressure test that for sure.
Yeah, and then I think the third area that I would flag, and this is one that tends to catch companies that have been issuing equity compensation in the period leading up to the transaction, is what the SEC calls cheap stock. So if your company granted equity awards in the 12 to 18 months before SPAC announcement at values that look materially low compared to the implied merger valuation, the SEC is going to ask you to reconcile that difference. And, this comes up more often than people would expect, because private companies aren't always thinking about their equity award valuations in the context of where the company might be headed And so if the SEC concludes the awards were undervalued, the consequences recognizing additional compensation expense historically, which has real earnings implications, obviously. And so the fix here is making sure grant date valuations are supported by independent valuation professionals and thoroughly documented at the time of issuance. And that's not something you reconstruct effectively after the fact, right? So I think that's why this conversation needs to happen well before any SPAC process begins.
Yeah, I think it's also worth adding that the SEC is pretty consistent about this. They flag it, I think, in nearly every SPAC filing review where awards were granted in the lead up to that transaction. So it's not an obscure comment. It's a pretty standard question that they do tend to highlight. So companies that, like you mentioned, have their documentation in line are fine. I think it's the people that are kind of caught off guard and not ready to respond to that have to struggle through getting that all shored up.
Yeah, and I think for maybe the last question I have is there anything specifically on the post-closing period that CFOs should be thinking about proactively?
Yeah, I think for a lot of, if you probably interview some CFOs that have been through this, they would probably attest that the first 2 reporting cycles after a de-SPAC consistently are the most challenging period, right? So sponsor lockup expirations create that share overhang that we mentioned earlier. Institutional ownership is still building. Your finance team is learning how to operate as a public company. They're managing earnings calls, the first 10Q, the first interactions maybe with sell-side analysts, while also just running the business, if you will. The companies that have done the preparation, I think, use that period to help build more credibility. The ones that haven't, I think, discover very quickly that the technical accounting issues like the warrant reevaluation, the earnout classification become highly visible at exactly the moment when you probably have the least amount of time and margin for error to get that all cleaned up. And those issues aren't going to necessarily go away just because the deal is closed.
Yeah, I do think that's a really good way to kind of set up where we're headed into episode 2. So to really wrap up episode 1, SPACs are a genuinely viable path to the public markets right now. And the current resurgence is structurally more credible than what we saw in 2021. The PE-backed company profile is central to that story. The equity instrument landscape, so your founder shares, your warrants, your PIPE financing, the earnouts, all of that we've talked about, creates a real complexity that needs to be understood before any agreement is signed, not after. And then the readiness conversation really is the most important one a CFO can have before this process starts.
Yeah, and in episode 2, we're going to get into the accounting and reporting mechanics in real depth. So the accounting acquirer determination, which sounds technical, but really drives the enormous downstream consequences. What a reverse recapitalization actually means for how your financial statements will look, the warrant and earnout classification frameworks at a high level, the Super 8K and what has to happen in those 4 business days, but also hitting on the ICFR obligations that tend to surprise companies coming out of a de-SPAC. If you're close to this process or you think you might be, I think sticking around for episode 2 could be worth your time.
All right. Well, thank you so much for listening to Accounting Matters, and we'll catch you in the next episode.